Welcome back to the monthly portfolio update. I hope you'll find the information in this video useful, but disclaimer, please note that this is not investing advice. It's just my portfolio as it stands on Wednesday, May 1st, and it can change at any time without previous notification. Following an investment strategy without doing the work yourself is almost guaranteed to result in losses. So please be careful since it's your responsibility to do your own research before investing. At the end of the video, in the bonus section, we will discuss about investing when there is blood in the streets. As we'll see, a current but also evergreen subject in all of human existence. This month, relevant to the theme of the video, I started trading more, so I did some dollar cost averaging in light of the price drops caused by the bad US inflation reports and the Israel-Iran conflict. So I accumulated a little bit more of the BET, the Romanian Market Index ETF, and Simtel, the renewable solar energy company, as well as UiPath, which is also a Romanian tech company but listed in the US, and a bit of Tesla before the good news came in. I also earned a few more altcoins via launch pools and learn and earn programs. On the other hand, I sold a little bit of Prosus now that I have waited for 2 years for it to go up significantly closer to now. I noticed lately that I can get a somewhat predictable good return on plus minus 10% moves, meaning buy when it's minus 10% of my cost basis and sell at plus 10%. I've done this a few times already, which actually returns some nice cash flow and reduces the China exposure risk, but of course the eventual reward as well at the same time. In terms of cash flow, I had just one coupon from my Romanian government bonds that covered my living expenses for the month. The portfolio at the end of the month, as of May 1st, 2024, is looking like this. Please pause the video if you want to analyze each individual investment in detail, but more or less, there are the same assets as last month with different allocation due to trading and price moves, which are of course normal. There are no new additions and the overall portfolio return this month was minus 0.9%, which of course is not great because of the negative return, but also with all the turmoil this month is not bad either. Year to date, the portfolio is up 4.41%. Actually, excepting last trading day drop in US markets at approximately minus 5% in crypto, the portfolio would have been slightly positive to flat, but this is kind of like saying I would have not drowned in the river if that small portion was not as deep. Well, yes, that is correct, but I did drown though. So I took my losses with a smiley face, and it is what it is. That being said, the current pyramid allocation portfolio looks something like this. You can see a decrease in risk assets, the asymmetric risk reward, crypto, and growth stocks, which was somewhat mitigated by the increase in cash and commodities, which, as I mentioned, it's only gold for me. This, I believe, shows the value of the pyramid allocation portfolio to protect in bad times while participating in the growth as well. Before going to the next section, if you are interested in the subject matter, you can leave a like and subscribe to the channel. It really helps bringing this completely free information to more and more people. In today's bonus section, we discuss about investing when there is blood in the streets. Since the threat of conflict seems to be increasing with Russia, Ukraine, Israel versus Palestine, and now Israel and Iran, China and Taiwan, US and Canada, etc. Just joking on the last one. But how can we prepare for this? Firstly, I have some breaking news. Not sure if you already knew this, but war is bad. However, it is also something that's been happening throughout all of human existence. Since I didn't manage to discuss the topic too much when Russia invaded Ukraine because the channel was just starting and I wanted to focus on the portfolio allocation and other investment strategies rather than focusing on the war itself. However, we see around us an increase in conflicts or potential conflicts. There are three scenarios for war. First, the prospect of war. Remarkably, this stage is where the assets start to go down regardless if the war happens or not. Second, the actual war. And third, total annihilation. Now, when I say total annihilation is a bit of an exaggeration, meaning very, very significant damages. Think world wars. The downside of war is both the unnecessary loss of lives and the lowering of living standards for the population, resulting in a shrinking economy. This being an investing channel, we will focus on the economic impact of wars. Since war is a political decision and not an economic one, the outcomes cannot be predicted using quote-unquote economic theory, and investors usually flee the markets to safe haven assets like gold or even cash. So, what to do in the case that you don't want to follow the traditional path? Well, while there were prolonged wars like the 30-year War between 1618 to 1648, the good news is that usually conflicts are settled in a few years. Even the world wars took somewhere between 4 to 6 years. There is a famous saying attributed to Baron Rothschild, who made a fortune buying in the panic that followed the Battle of Waterloo against Napoleon on June 18, 1815. Buy when there's blood in the streets, even if the blood is your own. This is contrarian investing at its heart, the strongly held belief that the worse things seem in the market, the better the opportunities are for profit. The contrarian view worked well for Sir John Templeton, who borrowed $10,000 before World War II and bought every stock under $1 on the New York Stock Exchange. Over the next 4 years, the portfolio of cheap stocks quadrupled in value. It was the beginning of his fortune and spectacular investing career. So, which option should you choose? Going to safe haven assets or the contrarian investing approach? Of course, the answer is not easy and you should be the one making your own decision based on your risk profile. What works for one person might not work for the next. But let me tell you how I see things. As a note, this was written on April 16 and Iran just bombed Israel and they were deciding on how to retaliate. So there was the fog of war present at that time. Because usually assets drop at the prospect of war and there is no war, they will bounce back, right back after. So if you sell at the beginning of the stage, you will catch the panic lows. As we've seen in Ukraine, also if there is a somewhat moderate war, the markets will rebound quite quickly. So the question is, there will be total annihilation war, like the Second World War, or a small regional conflict. My belief is that if it gets really, really bad, probably you'll have much bigger problems than investing. So the contrarian approach works well for me. So what have I done concretely to prepare for this? You can't predict the future, so we continue with the same strategy and add a little bit of hedging. First, of course, is the pyramid portfolio that has some implicit hedging in it. Gold went up significantly due to the conflict. While it might go down afterwards if nothing really happens, I think it will still be up overall. So that was a good bet. Have some cash available to buy the eventual dips. Now I'm talking steps of over 5%, not 3 to 2% moves, via dollar cost averaging, meaning don't invest all the funds at once at the first drop. I have my own cash position and also secure new funds in the eventuality that markets will drop significantly. Last but not least, remember that timing the market is always better than timing the market. It might seem unreal, but if you buy the tops every time, you will still perform better than if you are out of the market. This graph is very interesting. We see that since 1988, if you buy S&P 500 at a new all-time high, actually, medium to long term, you perform better than doing random dollar cost averaging. Now, be careful with those types of data because it is cherry-picked, meaning if you pick different assets, different time frames, different conditions, it might not hold true. But one thing is clear, holding asset is not bad. And one last thing, if things get really, really bad, we might not be able to buy back in. So selling now is actually a bet that the conflict will get worse but have no lasting impact, that it will have some significant duration, because if it takes just a week or so, it will bounce right back and will most likely not catch the greatest price, and that we somehow will be able to pick a bottom to buy right back in, which, while I think I'm a relatively smart enough person, seems unlikely because I don't have the resources of a BlackRock or some other big investment firm, nor do I have any special military inside knowledge to speculate the pivotal moments of a war. That's all for today. I hope you liked the video and got a new way to look at war's impact on investing. If you did, don't forget to like and subscribe, and see you next month. Maybe not on the front. Ciao ciao.